So the big question is this: how are investors like us, who don't have a PhD in finance or millions to start investing, how do we grow our bank accounts to build real savings and retirements and yet still have the time to do what we really love? That is the question, and this podcast will give you the answer.
Our max loss in that case. And this equation equals 0 because if you expected to play all sides of the spread, you'd expect to make no money. And then our second equation is just a very simple sum of probabilities. Now you'll notice that these are two equations, three unknowns, which is not helpful. So the way we solve that is by making a second big assumption. We'll guess what P below is. Now you'll recall that at the beginning, we said that we start building our spreads at the very edge of our option chain. We do that so that we can make an estimated guess. So our logic is as follows. If we're at the very edge of our option chain, if the market does not even offer a way to play, in this case, lower strike prices, then we can assume that the probability of that stock ending below that edge is very low. So in our case, we'll make a guess that our probability below is 2%. And with that, we'll have three equations, three unknowns, and we can solve those equations, and we'll get the following. We'll get that P below, which is our guess, is 2%, P between is 2.8%, and P above is 95.2%. Translating this to our option chain, this is what it's telling us, right? That's our probability of being in between our two legs. That's our probability of being below. That's our probability of being above. Now, this isn't very helpful. I mean, anyone could have calculated that just by looking at that option chain. So what we do next is we keep on building debit spreads. So we move down an interval, and the really cool thing here is that we no longer have to guess a probability below because we calculated that already. We know that our probability below 207.5 was 2%, that's our guess, and we know that our probability of being in between 207.5 and 212 was 2.8%. So for our new spread, we know that the probability of being below 212 is just going to be the sum of those two. Now, we'll keep on doing this until we get to our at-the-money price. When we get there, we'll go to the other edge of our option chain, to the highest strike prices, and we'll repeat the same process, building spreads, but using calls this time instead of puts. We're doing and with another guess for P above instead of P below. We do this because we were concerned about how very deep in the money options might be priced, and so to avoid that, that's why we build our spreads with puts and then calls for each edge. So going through all of this, for the Apple example, we end up with this. So for Apple trading at 227 on October 6th, we created this probability distribution using the option chain for October 11th. And Apple actually ended up trading in this region right here, which is pretty exciting. But yeah, that's what our model comes up with. Now, with all that being explained, which seems really cool, we'll talk about our model's limitations.
There's definitely some limitations to the model. The model relies on like a single snapshot of what the options trader's opinion of the company is. There's no fundamental analysis. It's purely based off of where options traders believe the company will end up. And then there exists a lot of fluctuation and volatility because of this. It's based each day on what trades are made. And since there's a lot of fluctuation in higher risk like option trade, the options trader ends up with very different per day. If you run it on Monday and on Tuesday, you'll end up with like different distributions. And then we don't have data on all our stocks. We're using an API that provides us data with a lot of stocks, but not all that you might be interested in. And we have some other like real-time data issues simply due to the API we're using. And then as the assumptions made relate, we assume a uniform distribution for each bucket, which is not quite accurate. And these issues end up compounding and propagating throughout our model. So as you get closer and further from the end, you'll end up with values that are more potentially incorrect.
So for our next steps, we hope to continue to test our model against the realized stock values at certain expiration dates, repeating our process and testing for accuracy, in addition to replicating it with other companies as well. We plan to also get feedback and continued learning to improve our estimations, our probability distribution estimations from below to above guesses, and this can be in forms of using volume data in order to figure out the upper and lower bounds, in addition to maybe even using implied volatility to understand the upper and lower bounds of our estimates. A third point is to have availability for everyone in the IC. We hope to have analysts to use this tool as a metric. I'd like to iterate that this should only be solely as a metric, but not only should not be the end-all be-all decision factor with presentations. It should be a tool for analysts to understand what the next steps are and understand the fundamentals from this technical standpoint. And for the last point, we'd also like to have access to a real-time option database, like an API from IEX, and this is $9 per month. But we're also looking into other options to further improve our model from other APIs as well.
All right, awesome. That concludes. And any questions? We'll be glad to answer those. Yeah.
So what was kind of the inspiration behind this method?
Great question. Basically, if you're looking at option chains, you're not really sure what the market is telling you. That information is not easy to interpret and to digest, I guess. And so what we wanted to do is take that information and put it in a way that was a lot easier to interpret. So, which is what we did. I mean, looking at that graph, you can clearly tell that for that week, the options market was favoring an upward move, right? And so that's what we're aiming to, that the model aims to do.
Could I do a quick follow-up? Yeah. So, is there another model being employed elsewhere? They're using like a guideline, or is this kind of new territory you guys are exploring?
That would be new territory. Yeah, like they were saying we'd like to implement some learning into it, see how well our guesses actually work, and refine that. Have a question?
Yeah, is there any chance you could go back to the chain you used?
Yeah.
So just out of, I might have
chain or does it?
Yeah, they're all from the same.
Yeah.
Okay, so just how remind me how far this was in the future, this particular chain?
The option chain was captured on a Sunday. The expiration dates were for the coming Friday, 5 days from the time.
5 days?
Yeah.
Okay. And so is it possible to also build it out for much longer term?
Oh yeah, you can choose your expiration date.
Okay.
That's no problem. I mean, this histogram looks pretty narrow, which makes sense because you wouldn't expect a massive move in 5 days. If you were to build this with an option chain 2 months from that time, you'd expect a larger distribution. But yeah, you pick your stock ticker, you pick your expiration date, the model does the rest and builds the probability distribution.
And then can you talk just a little, sorry.
Yeah, go ahead.
Can you just talk a little bit about the guess? I mean, did you just kind of say 2%, being honest?
Yeah, so this example right here had a lot of human input in that we tried different guesses, saw what happened. Some guesses would just break the entire thing, others wouldn't. If you look at this, that's interesting because our probability below guess is 2%, our probability above guess is 0.1%. So in a sense, it's interesting that the market is giving a bigger probability to a large downward move than it would to a higher upward move. So yeah, those guesses were a bit of trial and error. Like we said, we want to incorporate some learning, see if it's able to detect good guesses from bad guesses in its own, which is simple for some cases. Like if you get probabilities over 100 or negative probabilities, you know that's a bad guess. And then we'd like to validate how well those results actually are once we have a good guess. That at least makes sense.
Great work on this, guys.
Thanks. Sorry, you have another one?
Yeah, why, is there a reason you guys did it based off of like the prices like this instead of just getting like the implied volatility and using that as like the standard deviation and then just making like a normal distribution based on that, or?
Yeah, we spent quite some time considering that approach as well as this one. Our main concern with that, and Roy did some pretty great research in this area, was that we weren't too sure how implied volatility would translate to actual volatility. And so our thought process, and when we looked at using Black-Scholes and stuff to build volatility and stuff, and our main concern was how those theoretical calculations would translate properly to actual market data. So in the end, our decision was to use what the actual market is pricing and then kind of reverse that into probabilities instead of starting with like implied volatility. You had another one?
Just a quick comment. You said you're doing more research on how to distinguish like a good guess from a bad guess.
Yeah.
Like, I think it'd be extremely helpful if like, I don't know if you're already planning on this, like some single KPI that like spits out for every iteration to tell you like, if we're in this threshold, it's a pretty good guess. If we're beyond like some critical value, then you have to take this data with a grain of salt.
That does sound pretty cool, but not.
Yeah, I don't know how the mechanics would work out, but I just know like when companies are building these new models, that's something they usually want pretty standard with. It's just some kind of critical value number, like on a reactor that's saying, okay, we're in trouble territory, you can't use this data.
Yeah. I mean, as the way it is right now, there's definitely some criteria that you yourself would have to use. If this came out with like a 100 or 90% probability of like a huge move, you'd say it, right? This data's probably not work so. But we'll keep on working. We're doing a lot of work on pre-processing that option chain, seeing what works well, and we'll implement that as well.
So when you look at like pre-processing it and you're factoring in the implied volatility by time value versus strike price, how do you figure out which one to buy the put for and then where to sell the put based on like that $5 spread, like closer to strike price or further from strike price based on the actual price of the option? How do you figure out which strike prices to use? Do you want to use the ones closest to the current price or further away?
Choosing the interval between strike prices is something that we're still working on. Like the $5 interval that we chose here was handpicked. And then with whatever interval we choose, we'll start at the money and then go towards the edge with that interval as close to the edge as we can. And then we'll build our spreads from the edge.
And you look for the smallest difference between spreads?
Yeah, we can try that, but then we ran into problems where we're probably trying to be way too accurate, and our model just does not, the probabilities that come out does not really make sense. Like if we tried and use the smallest strike difference here that we could use would be $2.5, which is very detailed, and our probabilities just did not make sense that way. So we had to generalize a bit to get results that actually made sense.
Can you scale this method to other companies?
Oh yeah, absolutely. Like we were saying, you can pick the ticker you want to look at, pick your expiration date, and this will build your probability distribution for you.
Without like human interaction?
Ideally. Right now, we're still figuring out how to pre-process data so that it'll work without any sort of intervention, but that's the end. Right now, you might need some human intervention to modify your initial guesses or to see if the data makes sense or not.
Good job. Yeah.
Okay. Any other questions?
Woo! Want more stock market secrets? If so, go get your free copy of my best-selling book, 9 to Noon. You can get your free copy plus $11,176 of unannounced bonuses completely for free at 9tonoonsecrets.com. Inside 9 to Noon, you'll find the top 38 secrets we use to double our portfolios every 2 years and make upwards of 10% per trade daily.